Hello, everybody. Hello, everybody. Hello, everybody. Hello, everybody. Welcome back to our third lesson. This is lesson number 3, and we are doing Forex basic lessons. And on today's lesson, we are focusing on Forex analysis. So please do comment down below if you are here. Drop a comment down below so I can know that you're here. Do let me know where you're from. Let me know where you're from. Let me know who your name is. If you can hear me clearly, let me know. And also, don't forget to share the live broadcast with your friends and family who are interested in trading so we can, impact more lives. So, do drop a comment down below. Drop a comment down below. Let me know if you are here and you're excited, because I know I am excited for today's lesson. So this is Ray from George and ready for the next session. Very happy to hear you, Ostazen. Thank you so much for coming back once again. If you are here, please do drop a comment down below. Let me know who you are, where you're from. Let me know if you can hear me clearly. And I'm very excited to be here with you today. Do share the live broadcast with your friends. Hello, Femi from Nigeria. Welcome, Femi. Happy to have you on here. Do drop a comment, guys. Comment down below. Let me know where you're from. Let me know your name. This is Ayanda from Gauteng. Happy to have you on here as well. Please do me a favor to share the live broadcast once more. And whilst you are doing that, we are going to be looking at our disclaimer. So you can go through our disclaimer once more. Please do share the live broadcast. Let me know if you're here and you're excited. I think today's session is going to be really interesting and very, very nice. I cannot wait to share my expertise with you guys. So do share the live comment before I do comment and start. So please do drop a comment down below. Let me know who you are, where you're from. I'm very excited to have you on here. So once again, any opinion, news, research, prices, analysis, or other information discussed in this webinar or linked to this presentation is provided as general commentary and does not constitute as any market advice. Okay, so that is our disclaimer. From today, I see Witness from Rustenburg in South Africa. Welcome. Once again, don't forget, guys, we have got a 100% deposit bonus after attending the lesson, and you will be given a promo code to use at the end that you can, profit from, even use as you are depositing into your trading account. And again, you will get a certificate of attendance if you attend and you register for every single lesson in this course. And again, you will receive a trader's guidebook in a PDF format, and that is exactly what we are up to. Now, moving on swiftly, this is about me, so do let me know who you're from before we can move forward. I am very excited to have you. I see we've got Jay from Umkababa, KwaZulu Natal. Happy to have you, bro. So please do let me know where you're from, what you're about, how long have you been trading for. We've got Nosy from Joburg. We can see you. We have Mikale from Joburg. We can see you. We have Witness from Rustenburg. Thank you so much for joining in. We have Investor from Nigeria. Happy to have you here. So let me know who you are, what you're about, where you're from, and I'm very excited to have met you today. And I'm very excited to have you. Igena from Nigeria. Happy to have you, bro. So once again, guys, my name is Dr. Martin, and I am a professional Forex trader with an experience of 7+ years. And I am a trading coach and an analyst. I focus mainly on market structure and trend trading, and I teach how to trade and to manage your money and find your trading style. I have trained over 10,000 individuals with a combined number of 5,000 plus in person and 5,000 as well online. So that is who I am. I have been trading for 7 years, and I cannot wait today to share my expertise with you and to share my trading experience and knowledge with you guys. Welcome, default. We see you. So, guys, what we are looking at today, we're going to be looking at how to analyze the forex markets, and we're going to be looking at fundamental analysis as well, and we're going to be looking at technical analysis. We're going to look at market trends in depth, and we're going to look at chart patterns as well. So that's exactly what we are doing today, and I cannot wait to show you exactly what it is that we do have in store for you. Now, the first thing that I want to focus on is what is forex, right? So what is forex analysis? So forex analysis is used by retail traders, retail traders who, obviously have to determine whether they are buying or selling in the markets, and they use what we call forex analysis. So now forex analysis, differs and is made up of two different ways, which are namely fundamental analysis, and we also have technical analysis. So now these two types of analysis are the main analysis that we do have in the forex industry, and we can either analyze the market fundamentally or analyze the market technically. So as you can see, even on the picture on the screen there, on the fundamental side of things, we have analysis that is based on data that would be released, fundamentally, and data that would be released based on the performance of specific, currencies in different countries. So that's exactly what we do have. So fundamental analysis, measures inflation, unemployment, it measures GDP, it measures the interest rates of a currency, and this will then affect how a market moves. Every single market that we will be looking at, we look at those major factors that affect and influence the market to be able to understand the next directional bias of the market. So as you can see, we've got different examples over there. We've got energy, materials, industrials, we've got utilities, we've got healthcare, we've got financials, we have got consumer, discretionaries, we've got consumer staples, we have got a whole lot more other things that we do have on the charts that are on there, and all of these factors that are named below that fundamental point eventually become what moves and shapes the market. Now, there's people that trade fundamentals and are called fundamental traders. These are people that trade based on fundamental events that are obviously released on every app that they would use, and they would then take trades based off of the fundamental release that would be given to them for them to be able to find trading ideas. Now, we have also got technical analysis, and technical analysis includes graph analysis, and on the graph analysis you will see that we have got trends and patterns, and we have also got graphic analysis, which is obviously price action and candlestick patterns. We have also got volume analysis, we have got indicator analysis, and this is what we are going to be doing today. So if you are here and you are excited to be learning on one of these two ways of analysis, please do drop a comment. Let me know how you feel about today's session, and we are moving on swiftly. Now, introducing fundamental analysis. This is what I would say, that fundamental analysis is a way of looking at the forex market by analyzing economic, social, and political forces that may affect currency prices. As I've mentioned, currency rates, the basic instruments of foreign exchange market, are affected by major financial news. Fundamental statistical reports and geopolitical events are what actually moves the market at specific times. Now, we have got websites where we can check our fundamentals, and the very first website that we do have is obviously OctaFX /market/news. That's where we can get our fundamentals directly on the OctaFX platform. When we do click on there, we're going to be redirected to the OctaFX fundamental page, and that is where we can be able to see these news that affect specific currency pairs. And you can see we have got an article today that was written even under the Forex news tab. That's where you'll be able to get these news. So you'll be able to see that the Euro USD began the week sideways, clinging to the 1.0800 mark amidst the slightly upbeat market sentiment sponsored by an improvement in USD ceiling. So this is a fundamental article that was released today, and you can obviously scroll through to look at other articles as well, and we will come back to this to look at what we are talking about a little bit in depth, so you guys can get to understand exactly what fundamental analysis is. And over and above us being able to find fundamental events on the OctaFX website, website. We can also be able to find fundamentals on investing.com. We can still be able to find fundamentals on Bloomberg. We can be able to find fundamentals on dailyfx.com, on fxstreet.com, and Forex Factory as well. And these are one of the websites that you can obviously look at. And particularly, I prefer the investing.com website, and I will give you guys my reasons as to why I prefer this website. So let me just do this quickly so you guys can be able to understand. So this website is a website that would help you understand the fundamentals of whatever currency pair that you're looking at. And at the top there we have got these tabs that we do have over there, and right there we have got economic calendar. So that's where we're going to click to be able to see what exactly fundamentals we do have. So on the economic calendar, you have got all these fundamentals that are given to you and their dates. So you'll notice that we do have fundamentals all day in Canada. So obviously this would affect the Canadian dollar as well if we do have fundamentals the whole day in Canada. And in CHF, this is obviously fundamentals in CHF, in HKD, in Euro. We also have fundamentals in Brazil, in the USD as well. So you look at the times that are given to you on the side to be able to understand exactly what fundamentals we do have. And they also give you the fundamental event that is on there. So as you can see, in the morning we had an FOMC member Bostic speaks. So we had a member speaking on FOMC today in the morning at 10:50, and these were medium impact news. So the stars that you see there are obviously giving us the impact of the news that we are trading. So we do have high, medium, and low impact news. High impact news would obviously be the news that you do want to look at, because there's a lot of volatility there, especially if you're trading fundamentals, and the mid impact news as well. With the low impact, sometimes these do impact and move the market drastically, but sometimes it actually doesn't move the market drastically. So these are the things that you want to look at when you're trading. So in the middle there, we do have the fundamental events name on the middle, and there you do have the impact, and then there you do have the currency, and then they give you the time as well. And then you can also look at the actual price that the fundamentals actually did give out. So you can actually see that the actual price was 2.10, but the forecasted price was 1.80, and the previous price was 1.7, and the actual is what comes out after the fundamentals actually move the market in that particular time that you're looking at. So now let's go back to our presentation, and let us look at the other facts that we had, the other factors that we do have. So that is exactly what I do look at. So investing.com helps you understand exactly the fundamentals that you do have, and you're able to obviously look at different elements and aspects of what is happening in that specific currency pair that you're looking at, right? And then we've got 8 major central banks, which would obviously be the Australia Reserve Bank. So this is the Bank of Australia. So that RBA stands for that Reserve Bank of Australia. So you do want to obviously understand these abbreviations as well. And in Canada, we've got the Bank of Canada, and that is abbreviated by BOC. And we've got the European Union, that is abbreviated by the ECB. So that's the European Central Bank. And in Japan, we've got the Bank of Japan, which is obviously BOJ. And in New Zealand, we've got the Reserve Bank of New Zealand, and that would be the RBNZ. And then we've got Switzerland, which is obviously the Swiss National Bank, which would be abbreviated as the SNB. And the United Kingdom has the Bank of England, and the United States has the Federal Reserve System. And these are the major banks that move these specific currency pairs that we are looking at. So if we've got a Fed rate in the States, then we do know that the market is going to move drastically, because that major central bank is actually releasing data that would move the market. If you're here and you are still following, please do let me know. Please do let me know. I see Arthur Dagumi said, I'm Arthur from SA and Randfontein. It's my first time here. We welcome you, bro. We welcome you, and we appreciate your presence. And we have this specific tab. And now how to use fundamental analysis in trading is you look out for the events of the week or the day, and your focus should be on the high impact news, and you confirm the release time and understand the meaning of the event and possible outcome. Take note of the previous and the forecast, as I did show you on the previous slide, and then you wait for the news release to actually be able to trade. Then you combine this with your technical analysis and your strategy, and you are then able to trade these fundamentals. For example, every first Friday of the month, we have got what we call non-farm payroll. So it happens at 2:30 South African time every first Friday of the month. So when those news are released, you obviously look at the event of that specific day. You confirm that you do have those fundamentals for the day, and obviously because this is non-farm payroll, the event would be a high impact fundamental, and the release time would be 2:30, and you need to confirm that and understand the meaning of the event and its possible outcome. Then you take note of the previous and the forecasted price, and then you wait for the news release, and you combine that with your technical analysis, and then you're able to actually get an entry to the direction of the fundamentals that you're looking at. Okay, now as I did show you guys, right, so we looked at for one, we looked at the economic calendar. So I did I did show you this on the economic calendar. So we're going to be looking at the economic calendar. So you would have your release times on the side, you would have the currency, you would have the impact of the news, and you would have the event name. And then this is where you see your forecast and your previous price, and then you will actually be able to get that actual data that would come out. So this happens exactly at the time that you would be set on the side over there as well. And obviously you can filter out the low and the medium impact news as well. So you can obviously go to your settings over here on filters, and then you can decide that you want to filter out all the low and medium. So you would obviously want to see the high impact, and then you apply, and then this will obviously show you the high impact news that we did have for the day. And obviously over here for the day specifically, we had Canada not moving for the rest of the day, and that's how you would want to filter out the impact of news that you're looking at. Okay, so that's exactly what you would want to obviously look at. So you look at the economic calendar, you confirm the time, and then you confirm the event that's going to happen, and then you confirm with your technicals, and you then take trades based off of the direction of what you would have seen. Now we're looking at technical analysis. So in technical analysis is a study of historical price action in order to identify patterns and determine probabilities of the future direction of price. Technical analysts look for similar patterns that have formed in the past and will form trade ideas, believing that price could act in the same way that it did before, right? So you use previous data and current data to predict future data. So technical analysis involves the use of trends for one, support and resistance, number two, indicators, number three, chart patterns, number four, and number five, and it involves candlestick patterns as well. So we're going to take a look right now at the 6 tenets of Dow theory. So the Dow theory is a common ancestor to most principles of modern technical analysis and the general line of trend analysis. So the 6 tenets or principles that would be applied to the Dow theory portfolio are as follows. For one, we have got the market discounts every time, and it states that there are 3 types of market trends. And number 3, it states that the primary trends are split into 3 phases, and indices must confirm each other. And then it also states that volume should confirm the price. And lastly, it states that trends persist until there is a clear reversal. And that's exactly what the 6 tenets of the Dow theory are. Now, there are 3 types of market trends. I'm sure you are familiar with this. If you are new to trading, you should understand that there are 3 types of market trends. We have got what we call an uptrend, which is obviously made of higher lows and higher highs, as you can see even on the blue diagram that we do have on the screen. And then you do have a sideways market or a consolidating market, which is obviously a market that moves neither up or down, but moves sideways, even as the temps suggest. And then we do have what we call a downtrending market, which is obviously made out of lower highs and lower lows, even as you can see on the red diagram that you can see on the screen. So on the uptrend, these lows have to maintain for us to know that the market is still fairly trending up, and these highs have to maintain for us to know that the market is still bearish trending. As we have established on the previous sessions, that the word bearish means downtrend and the word bullish means up. So whenever you hear me mention bullish and bearish, you would then understand exactly what I mean by that. And these are the three phases of the trend, as we have established on the previous theory, that we have got the accumulation phase, we've got the absorption phase, and then we have got what we call the distribution phase. And these are the three phases of a trend. And then we also have, the trend that would obviously be trending up. And whenever the market hits that specific trend line that's drawn on there, you want to place buys. So the market would obviously create these lows, and the market, as the market is creating these lows, these are areas and levels you want to be buying from, because as you would know, the rule of investment is you want to buy low. So whenever the market establishes these low prices, this is where you want to buy from. And luckily, rather fortunate enough, we have got what we call the trend line to help and assist us determine future possible lows in the market for us to be able to then buy in this market. You do not want to be selling in a buying market. Strictly buys in a buying market. Whenever the market is trending up, you want to be looking for buys in that particular market, and that is very important to note. Okay, now this is what we do have. So the market would be trending up, and then it would be trending down. This is a sideways market, this is an uptrend, this is a downtrend. Now, how do we know that the market is an uptrend at this point? This low is obviously lower than the next low. So this low is higher than the previous low, okay? And how do we know this is a downtrend? This high is lower than the previous high. How do we know this is a sideways market? The market is maintaining on the lows and on the highs, and not either going up or down at this point, but it's moving to the side. Uptrend, the lows keep on getting higher, the lows keep on getting higher, the lows keep on getting higher, and that's how we know that there's an uptrend. With this, the highs keep getting lower. That's how we know that the market is trending down. And obviously, even here, you would obviously see that this is now beginning to trend up. Why? Because the lows keep on getting higher, and that's exactly how you want to be able to determine whether the market is trending up or down. Now, on chart patterns, a chart pattern is a graphical presentation of price movement by using a series of trend lines or curves. Chart patterns are the foundation of technical analysis. That's important to note. So chart patterns aren't bound by any specific principle or physical law. Their effectiveness highly depends on the number of market participants paying attention to them. They are caused by several factors, including human behavior. The types of chart patterns that we have got what we call a continuation chart pattern, and this is a pattern that helps traders identify opportunities to continue with the trend. And the most common continuation pattern includes a triangle pattern, a flag pattern, and a pennant pattern as well, which we are going to look at in the charts as well. And then what we also do have is that we have got the reversal chart patterns, and this is the opposite of a continuation pattern. And these patterns are used to look for scenarios to trade the reversal of a trend. So reversal patterns seek to find where trends have ended, and common reversal patterns are double tops, double bottoms, head and shoulders, inverse head and shoulders, and triple tops and triple bottoms. So it's important to note that these patterns are patterns that usually happen at the end of a trend, and these patterns consist of obviously double top patterns, double bottoms, triple top, triple bottoms, head and shoulders, and inverse head and shoulders, and so forth. And these are patterns that you want to look at. So continuation patterns indicate that after the chart pattern completes, the price will continue to move in the same direction it did prior to the chart pattern. The continuation pattern is simply traded by waiting for a breakout and entering either a buy or a sell position in the breakout direction. So in a continuation pattern, the breakout is in the same direction as the trend. So for example, if the market pushes up and then it pauses, the market will usually create a pattern that happens even on the pause that would happen from the move that would be uptrending. So that pause then is a pattern that would be created, and when the pattern gets broken, then you would obviously trade the continuation to the upside. And please do note that not every continuation pattern will result in a trend continuation. Some will result in a trend reversal where price moves in the opposite direction of the current trend, and that's important to understand. Now, here's the example I was talking about over here. So we've got this bullish continuation over here, but let's just go through the description of this page, and then we can obviously look at the examples that we do have. Now, the flag pattern occurs when a sharply trending price suddenly pauses, as I did say. So you've got a very strong trend, and then the market pauses. So that would be a flag chart pattern that we have, and it then breaks that range and continues in the original direction, giving you the opportunity to enter the second half of a trend at a better price than before the flag formed. So for example, we have the market pushing up, and then it pauses over here. So when it pauses like that, it creates a bullish flag pattern, as you can see, and then the market breaks out of here. As soon as it breaks out with this candlestick, you can then take an entry towards the direction of the trend. The same with that bearish flag pattern as well. You can see the market was dropping, and then it paused, creating that bearish flag pattern. From there, it broke out of that, and then you would obviously want to enter upon the retest of that break, which we are going to look at in a minute. And then from there, you can see the market dropping from there. So that's exactly what we do have over there. We've got that flag chart pattern that we do have, and then we've also got what we call a P-net, right? So P-nets are continuation chart patterns formed after strong moves. After a big upward or a downward move, buyers or sellers usually pause to catch their breath before the pair further in the same direction. This causes the price to consolidate and forms a tiny symmetrical triangle, which is called a P-net. While the price is still consolidating, more buyers or sellers usually decide to jump in on the strong move, forcing the price to burst out of the P-net formation. And this is exactly what we do have. So for an example, the market would be pushing up, and then it takes a pause right there. So this is how the P-net forms. So as you can see, we've got a triangular shape over there, and then from there you would want to trade the break, and you would obviously trade the move that obviously goes up. Even here, we've had the market pushing down, and then the market pauses over there. Then you would obviously want to trade upon the break of that move, and you are targeting downside. So this is what you need to consider. So the same distance that you had before the P-net forms would be the same distance that you target even upon the breakout. So even over here, we've had this distance, and then it paused, and then we are going to be targeting the same distance even to the downside. So that's what you could use for your target. And even over there, you can see on the side that we do have a similar example as well, and your entry would be obviously upon the break. That would be your entry over there, and your stop would be there, and then you could obviously target based off of the size that you had even before the pause that came with the P-net. And then we have also got what we call reversal chart patterns, and this is the opposite of a continuation pattern. This reversal chart pattern is used to look for scenarios to trade the reversal of a trend, and reversal patterns are found where trends have ended. If a reversal chart pattern forms during an uptrend, it hints that the trend will reverse and that price will head down soon. So if the market was going up and then you see a reversal chart pattern, this is usually an indication that the market is about to take a different turn, and you do want to consider that and do want to take note of that. Now, types of reversal chart pattern include a double top. And a double top is a chart pattern where the price reaches a high twice and fails to break out higher during the second attempt. The pattern comprises two peaks of nearly the same size and a bottom between them. The line running through the tops is the resistance line, which should be nearly horizontal. The pattern forms an M shape and is considered a bearish reversal pattern. This new minor support level is called the neckline. So that's where the low would be formed. That would be your neckline. This pattern is confirmed once the price breaches the low of the pullback between the two highs. Now, this is exactly what happens. So you have the market pushing up, and then it pauses. And then instead of pushing out of this first top, then it obviously goes down to break past this previous low. So as soon as it breaks out of this, then you can consider this pattern a double top. So you can only confirm once it breaks past the neckline there, even as stated. Then you can obviously confirm and conclude that you do have a pattern such as that double top. And this is exactly what you can obviously use as an example as well. You can see that the market pushed up to that first top, and this was a total of 270 points. It came back against that second top, failed, you can see even by the long wick there, and the minute we broke out of this low, then this is when we confirmed that the market would obviously be forming a double top. And again, look at this amount of pips. We have had that 270 pip difference, and as soon as the market comes back for a retest, this is where you would want to enter, and your target would be the same distance from the head to the neck, and you would obviously target from the neck to your target, and that would be 270 pips. That's how you would obviously use your targets on there as well. Now, you've also got a double bottom pattern, and a double bottom is a chart pattern and the price holds a low 2 times and fails to break lower during the second attempt and instead continues higher. This is the exact opposite of a double top. So the chart appears to take on the form of the letter W. Double bottoms are formed in downtrend and reverse it to the upside as price breaks through the resistance line that would have been formed even over here. So the market would be going down and pulls back, and from there it fails to break and obviously breaks out of there. So as soon as the market would break out of that resistance that would have been formed, this would then be considered a double bottom pattern. And once again, another example, you have that first bottom, the market pushes up, comes back, second bottom, and as soon as it breaks out, this is when we would confirm that this is a double bottom pattern, and we would want to enter upon what we call the retest. So that's exactly what you would obviously look for. I hope you guys are still following. I hope you guys are still following. So this is a double bottom pattern, as I did say, and then you break out, pull back. Upon the pullback, this is where you would want to enter to the upside. Okay, so we have also got this pattern, which is obviously one of the reversal patterns, and this is called a head and shoulder pattern. So the reason why this is called a head and shoulder pattern is obviously because it is shaped like the shoulders and the head of a man. So we do have this left shoulder, that the head, and then we do have the right shoulder. As you can see, it looks like it's the shoulders and the head, exactly as it's named. It looks like the shoulders and the head of a man. The head and shoulder pattern is a bearish reversal chart pattern that is described by 3 peaks, right? So the outside two are close in height and the middle is the highest. This illustrates that the upward trend is coming to an end, but the reversal is confirmed when the price drops below the neckline at 0.6. So even as you have seen here, right? So now what we do have is the market pushing up and then pausing, pushes up and then it pauses, but then look at that push up. So the push up doesn't entirely go up, but almost comes to the same level, like the height level at the left hand side, and then from there we can confirm this pattern by what? By the break, excuse me. So we can confirm this pattern by the break that occurs even over here. So by the time the market breaks out of this neckline, then we can obviously confirm that the market has created indeed a head and shoulder pattern by the break that happens exactly at this point. So before the market breaks out, this could potentially be a move that continues to the upside, but the minute the market breaks out of the neckline, then we can then confirm that this is indeed and in fact a head and shoulders pattern, and that's what we want to focus on as well. Let me just look at the comments quickly before I move on. You are very fast, so please reduce pace. We are missing important points. Okay, I'm going to try and go a bit slower. Yes, sir, you are very fast. Okay, I'm going to try and go a bit slow. So that's exactly what the head and shoulder pattern is. So the minute it breaks out of this level, then you can confirm this as a head and shoulder pattern. Now, when a head and shoulders pattern formation is seen in an uptrend, it signifies a major reversal. So you need to take account and note of that as you are trading. For an example, we do have the market trending up, and then from there you can see we have the market pushing to that point and pulling back, then it pushes again, pulls back, and then it pushes, then from there it breaks out. So this is what we would call a neckline, and the minute the market breaks out, this is where you would want to enter, and your target would obviously be the same distance from the head to the neck. That's how much you would be targeting even on your entry, and that would have been exactly on that particular point. So you target the distance from the head to the neck. That would be the same distance that you would target even from the neck to your take profit. And there you have another head and shoulders pattern. You can see over there you've got that left shoulder, you have the head, and you have the right shoulder. And then when the market breaks out, then you would obviously confirm this as the proper formation of a head and shoulder pattern, and you would obviously target the same distance from the neck to the head. That's the same target that you would use even to your take profit. Okay, hope you guys understood that. And then we have what we call an inverse head and shoulder. So this is the same thing as what we were looking at, but now inversed, right? So that's why they call it the inverse head and shoulder. And this is similar to the standard head and shoulder pattern, except that this is inverted, right? An inverse head and shoulder pattern, upon completion, it signals a bullish trend reversal, right? So traders typically enter into a long position when the price rises above the resistance of the neckline. And as I said, the minute it breaks out of this neckline, then you would obviously want to enter upon the break of this, and your target would still be the same distance from the head to the neck, and you're targeting from the neck to the same distance as of that of the head and the neck. And the example that we do have is this one that we do have on the screen there. So the market is downtrending, and all of a sudden it creates this first shoulder, comes back to this resistance and pushes down, comes back to resistance, reverses, comes back there, and then from there goes up. Upon the break that happens over there, this is when we confirm that we have got what we call an inverse head and shoulder, and our entry point would be upon the retest, and we're targeting the same distance from the head to the neckline, and we're going to put that same number of distance to the target that we would obviously have, right? So then again, what we do have is that now, how do we trade these chart patterns? There are three main steps in trading chart patterns. The first one would be time frame. So you decide on the time frame you want to trade, which should really reflect the type of a trader you are. A day trader should focus more on the lower time frames, such as the M5, the M15, the M30, and the M1. And swing and position traders should look for patterns in the high time frames, such as the H4, the daily, the weekly, and the monthly as well. And these are the kind of patterns that we would want to look at, right? And then in terms of the trend, you spot the chart pattern. Once you see the dominant trend, you can then spot the chart pattern to time the market, right? And then you want to confirm, right? You want to confirm your entries before taking the trade. So these are the four main steps that you want to consider when you are trading your chart pattern. So the first one would be the time frame. Decide on the time frame, and number two, identify the main trend of your preferred time frame, and then number three, spot the chart pattern, and number four, confirm entries before taking the trade. Okay, now we are going to be going to trendline drawings on the chart, so you guys can be able to see exactly what it is that we look at when we do trade. So once again, we do have the same charts that we were looking at even a few days ago. We were looking at gold, you guys would remember that, and we are looking at gold to be able to take trading decisions. Okay, so now what we have here is that we have, as I did mention on the lesson, we have got this chart over here, right? So I'm going to be looking at the H4 time frame. So at the top there, as I did say, we have got different time frames. So I will be looking at that time frame to actually be able to spot and identify my trend, right? So even as we did say, we said there are three types of trends. The first trend that we have is an uptrend. The second one is a sideways move, and the third one is a downtrending market, right? So as you guys can see, the market over here is moving sideways. So it's moving up, down, up, down, up, down, and up. So this would be considered a sideways move, okay? And then once again, we have got the market pushing and then pausing, pushing, pausing, pushing, pausing. So as it moves like that, it moves towards the downside, okay? And how you would want to spot and identify whether the market is trending down or up is you want to draw what we call a trend line, okay? So you want to draw what we call a trend line. So your trend line can be found exactly there at the top. And how I would personally draw a trend line is I would want to pick the highest point and take it to the second highest point. So this is exactly the kind of trend line that I would have had in this market, okay? let me just adjust it. So you would have wanted to look at this first point and this second point, and then you would have had a perfect trend line that you would have drawn over there. Okay. So that's exactly how then the trend line would have looked like. And based on this trend line, we would have been able to know that the market is a downtrending market at this point. So you would have obviously wanted to look at this trend line to know that the market is trending down. And again, you have also another trend line at the bottom that would have been formed over there. One second. So that's another trend line that you do have at the bottom there. Once again, don't forget how we draw. So as soon as you have 2 points over there, then you can obviously draw a trend line. So we do have this first point and the second point. Even there, we do have this first and second point, and the market is moving within the boundaries and parameters of these trend lines. And we can obviously look at other examples as well. And I will be going through our lesson in depth and in details according to what we did. So let me just do this. Let's go to our template, even as we had established last time that you can actually change between templates. So once again, let's look at the H4 time frame and be able to spot and identify what the trend is going to, and then let's try and draw a trend line over there. So on the H4, as you can see, the market here is moving sideways, and from there we've just broken out of the sideways move. And when we look at that, let's actually draw a trend line over there. So what we do have is that we would have drawn a trend line on there as well. So that's how our trend line would have looked like. Okay, so as I did say, we look at the first and the second point, and then the third point comes on there as well, and you can see the entry point that came on there as well, right? So we've got what we call this general trend line, and then the market has been forming an internal trend line as well over there. So what we do have over there as well is something like this. That would have helped as well to be able to find the moves that the market had created on its way up. So we've also got this trend line as well that we would have used to be able to find entries. So you would have been able to catch this move and that move as well, even as it's going up. Okay, so that's what we want to look at. So the first thing that you want to do when you're trading is you want to obviously observe and understand where the market is trending, and number two, you want to be able to spot and identify chart patterns, and then you want to agree on a time frame that you want to be using, and then you want to observe your entry points. So let's look at this time frame that we're looking at, right? So we're looking at the H4 time frame, and once again, we did establish that this would be a good time frame for swing traders. So once we do identify that, we're able to see that we do have the market bouncing off of this trend line, which means the market is trending up, and then from there we're going to go to a smaller time frame because we are day traders, to be able to try and identify chart patterns that would move towards the direction of our analysis. And once again, I can clearly and easily spot a chart pattern that we were able to identify even as we were looking at chart patterns. I am able to see that we do have a shoulder on there, and then we do have another shoulder even on here. We do have another shoulder even on here. We do have another shoulder even on there, and then we also have a head over there. So we do have a head as well over there. So just from looking at this, we do see that we do have an inverse head and shoulder formation. And once again, as you have seen even on the ads, we do have resistance levels that we do want to consider. So if we trade straight like that, then it's obviously not ideal. So what we want to look at now is we want to look at these parallel resistance levels. So if you trade straight like that, you would obviously notice that it's not really like working. So instead of having it like this, let me try and delete this line over there. delete this line because it's not working for us. So what we can obviously now use is we can use these trend lines to be able to draw and be able to spot and identify the break that would happen even from this inverse head and shoulder situation that we do have. So that's exactly how we would have this neckline that we do have. So you can see that we do have that shoulder, that head and that shoulder, and the breakout happened exactly there. So you would have obviously taken this entry point to the top. So if we speak about targets, then we would obviously measure out from the head to the neckline, as I did say, and that's about 45 pips. So from there you would have obviously wanted to enter on there, and you would have targeted 45 pips as well to the upside. So your target would have been somewhere there, and that would have been fulfilled nicely. So that would have been another example of how you would have been able to catch these specific moves that would happen. And then once again, what we do have on here as well is that we do have the market now. It just hit that trend line, and it's somewhat creating an interesting pattern as well. So remember that we said we can only confirm that this is a head and shoulder pattern once the market breaks out of here. But again, I would have personally observed this formation, with hopes that this eventually becomes what we would call an inverse head and shoulder pattern as well. And then once again, let me see. So you would have that head as well on there, and then I would want to observe this neckline. I would want to observe this neckline. So we do have a neckline over here. So what I would personally like to see is a shoulder forming on there, and then I would want to see the market closing above that level, and obviously retesting again, as we did say that we want to see those retests. And then as soon as the market retests over here, then I would obviously want to buy from that area to the upside, as we did say that this is a bullish market, and in the bullish market we do want to see such patterns forming. So this would be a pause that happened in the market, and from this pause we expect to see the market pushing towards the highs, as this is a bullish market. So that's exactly how you would want to look at these patterns. And once again, let's look at one more example to maybe understand how you would want to draw your trend lines and also be able to identify your pattern. So again, what I would personally look at is the H4 time frame. So what we do have on the H4 time frame over here is that we have a ranging market. So this is a sideways market. As you can see, we have got the support level over there. So we have this market hitting support and hitting resistance at the same time. So this is what we would have. So the market is moving sideways over here, and you would trade this upon the break of either the high or the low. Okay, so the market is currently moving sideways. So this is how a sideways move would obviously be identified, and that's exactly how you would want to look at your trends. And yeah, these are the lines that would help you identify your trends as you are trading. Are you guys following? Are you guys following? Can I just see more of your comments? If you guys are following, can you drop a comment down below? If you're still following, drop a comment down below if you're still following, so that I can know that we are still on the same page, okay? That I can know that we're still on the same page, okay? Please do drop a comment down below. Please do drop a comment down below. I hope I've been slow enough for you guys to understand. I hope I'm slow enough for you guys to understand. Please drop a comment down below. Please drop a comment down below. Let me know. Please drop a comment. Let me know. Okay, so what we do have again, guys, is what we call indicators, right? So indicators are mostly used to forecast price changes in the forex market, and they are calculations which take the volume and price of a certain financial instrument into account. So technical indicators can help you identify possible entry and exit points on specific trades. Okay, and that's really important to identify. That's really important to understand. Okay, and then we have got this moving average called this indicator called the moving average. So a moving average is a way to smooth out price fluctuations to help you distinguish between typical market noise and the actual trend direction. Okay, so moving averages are one of the most used technical indicators, and these moving averages do not predict price direction. Instead, they define the current direction with a bit of a lag. So they don't really predict on time, but they've got a bit of a lag, and that's how they actually work. Okay, so with indicators, you have got moving averages, which obviously are one of the indicators, as I did mention. So this is what an indicator that is called a moving average would look like, and this would be the 200 SMA. So if you look at it, it would look something like this, and this measures the direction of the trend, and I will get into that a bit later. So number one, a simple moving averages is a simple moving average. So this is an SMA, so it's abbreviated SMA, and this is the simplest type of moving averages. Instead of looking at the current price of the market, the moving average gives us a broader view, and we can now gauge the general directions of its future price. Okay, so that's exactly how what the simple moving average is. So how to calculate the SMA? So as SMA is calculated by adding up the last X number of periods closing prices and then dividing that number by X. For an example, okay, if you plotted a 5 period, the closing price for the last 5 hours then divided by that number 5, and that's exactly how you calculate the simple moving averages. Don't worry about the numbers. This is not too complicated, and you'll see this even as we are going through our charts. Okay, and then we have got types of moving averages. We have got that exponential moving average, and that EMA gives more weight to the most recent periods. It puts more emphasis on what traders are doing recently. So compared to the SMA, this gives us an emphasis on what traders are doing recently. And we have got a chart here in the bottom, a table that gives us the difference between the SMA and the EMA. So the SMA is the simple moving average, and it is slower but smoother when responding to price action. When looking at longer time frames, it could give you an idea of the overall trend, right? So the SMA is always good to look at it on a longer time frame or rather a higher time frame to get an idea of the overall trend, right? So the downside to using an SMA is that it might delay you too long, and you might miss out on a good entry price of the trade altogether. And on the EMA, the exponential moving average helps you catch trends very easily, which will result in higher profits, right? So the downside to using the exponential moving average is that you might get faked out when price are consolidating. So it's always good to use both of them and obviously conjoin the both of them to be able to get the most efficient results, right? And then we have also got what we call the RSI. This is the relative strength index. And this is a popular indicator that was developed by a technical analyst named John Wellis Wilder. It helps traders evaluate the strength of the current market. So RSI helps in identifying overbought and oversold conditions in the market. A movement of 70 or higher indicates overbought conditions and increases in the possibility of price weakening, which obviously means going down. So the price movement of 30 or lower indicates an oversold market conditions and increased possibility of strengthening the price, which means it has a high chance and probability of pushing the market up. A movement from above the center line, which would be the 50, indicates a falling trend. So if it's above the center line, a movement from above the center line below indicates a falling trend. So if it's below that 50, then it indicates a falling trend, and obviously if it's above, then it indicates a buying trend. So for an example, we have got this other side that obviously went above that 70%, which obviously would mean that the market is falling. And if it went even on that 30%, it means that the market would be oversold, and that would mean the market may change its direction. And this is good to obviously use as you understand the market trends as well. This would come in handy as well to help you confirm specific moves. Now let's go to our charts and look at these two indicators. Okay, so let's actually look at the same chart we were looking at, gold for an example. Okay, so you need to identify, so if you are trading, right, so when trading you want to obviously firstly identify the trend, which would obviously be identified by the trend lines, and then you want to identify the time frame in which you will be looking at, and then you want to obviously monitor an entry. And you could also use these indicators to help you identify possible entry points and even understand where the market may possibly be trending into. Okay, so you want to I personally use trading view. Let's actually go to trading view to understand this. So we do have this specific market that we're looking at. So suppose we are looking at this market, right? So this is on the H4. So let's look at the 4-hour time frame. Let's look at the H4 to actually understand this move and really get to understand what we do have. So I do have this chart that I was looking at, right? So we have this market that is obviously analyzed, and the market moved from the top and it pushed down, gave us this lower high, went down, came back and gave us this first, second and third top. So we had a triple top formation over there. As you can see, we have 1, 2, 3, and the market started pushing down, and this was the pause that happened. So now if you look at this, we have these indicators that are added on. I've got the moving average, so this would be the simple moving average, and then I've got the exponential moving average. So these are my personal periods that I use. I do have this the length at 18, so I've got the length at 18 on this one, and then I've got the length at 8. So remember, as I did say, so it looks at the previous 8 periods. So remember, you divide it by 8, so it's 8 divided by 8, and then it looks at the number of periods that would be stated on there as per given on the example that we just looked at. And then again, this looks at the previous 18 periods, even as mentioned on the previous slide. And then again, what we can add on there is we can add our RSI. So you can click there on moving averages, and then we can add RSI, so the relative strength index. So let's add that to our chart. No, what did I type? So that's RSI. So let's add that relative strength index to our chart. Okay, beautiful. Was it added? Okay, cool. So that was added. Okay, and then on the RSI, what we are looking at right now is just the blue lines. Don't mind the other line that you can see there, but we're just looking at the blue line, right? So anything that's above that's close to 70 is overbought, and that's close to that 30 level is oversold, and anything below that 50 is selling, as we had established. So the market would be selling if it's below that 50% line, then that would be selling up. Anything above or on that 70, close to that 70, that's overbought. Anything close to 30, that's oversold, which is why when you look at the market went to that 70%, even over there, that was overbought. The market came down. So below 50%, so the market pushed and pulled back. On that pullback, we were trending below that 50, and the market went down. Close to that 30%, the market pushed up, because then this was obviously oversold. Okay, now looking at this particular market that we do have right now, you can see that the market is close to that 70, which is obviously now overbought, which is why we're seeing the market going down. Now we have got an interesting formation over here. We have, for one, our shoulder, we have our head, and we have our shoulder. And based on our strategy, or rather our rules that we've spoken about, we said we want to draw a trend line over there the minute you identify such a thing. So you've got that shoulder, that head, and that shoulder, and the market just broke out of that neckline, which confirms us the market is going to go down. So when we speak of targets, our target would be from the head to the neckline. So you would obviously use this same length. So we would wait for that retest, and then we would enter on the retest to the downside. Now, the moving averages also are above the markets, which are also like another great indication that the market is particularly setting up for a sell. So moving averages are now trading above price. So price is currently low. Average is also the confirmation. This is on the H4 frame, right? So we're gonna wait for that retest. Once the market retest, and we know that would obviously be trade below that 50%. And once that happens, then you have what we call confluence, and you've got more than one reason to be able to enter in the trade, and you would obviously target exactly where the distance of the neck to the head would be, and that's exactly where you would obviously want to target. And that's exactly how you would want to use your moving averages and your oscillators as well. So moving on swiftly, what we do have over here now is that we are able to understand chart patterns, we're able to understand the market trends, and we're able to use moving averages even in support and resistance levels to be able to up according to all the factors that we have added onto our markets, building up what we call confluence. And that is exactly what we do have on today's lesson. And you can use my personal promo code until the 1st of June to double your deposit, and it can only be used once, and that would be Martin WS, and you will then be able to get your first your double deposit. And then again, I've got questions that I do have. So what does BOJ stand for? So I'll just be waiting on you guys to tell me, even on the chats. What does BOJ stand for? So what does BOJ mean? What does BOJ mean? Please do let me know. What does BOJ mean? What does BOJ mean? So do let me know, what does BOJ mean? And then I can move on swiftly knowing that you guys are with me. What does BOJ mean? Please do let me know in the comment section. What does BOJ mean? So yes, that stands for Bank of Japan, as we had established the different major banks, the 8 major central banks that we did have. So that stands for Bank of Japan. And where does the inverse head and shoulder pattern occur in a trend? Where does it occur in a trend, particularly the downtrend? Where does it occur? The inverse head and shoulder. I'll be waiting on the comment section. I'll be waiting. So where does it occur? Where does it occur? Where does it occur? Where does it occur? So please do drop your response on the comment section. Where does it occur? Yes, it occurs at the end of a downtrend, and that's exactly where it occurs. Okay, that's exactly where it occurs. And then name 2 continuation patterns. Name 2 continuation patterns. We did those right now. So name 2 continuation patterns. We covered those not so long ago. We covered those literally on today's session. So name 2 continuation patterns down below. Name 2 continuation patterns. I literally spoke about them. There's 2 patterns. There's 2 patterns that I spoke about. Yes. So name 2 continuation patterns. The first one would be a flag pattern. Yes. And the second one would be a pennant. Those are the 2 patterns that we do have, and we did establish that are continuation patterns. And those are exactly what we would want to focus on as we are, learning how to trade, and as we are trying to understand